Last week, two companies I own shares in released their interim results for the first half of the year of 2023. So I think it's worth a look. Now, they both provide excellent potential upside. Okay, that's why I go for small, micro, nano caps, because the upside can be very big, but there's also risk. Now, these two companies have two different risk profiles. The one with massive upside has a bit more risk than the other one. And even the other one has good upside potential, but there's less risk. So maybe there's more chance of attaining it. It's hard to say, but they've both very good companies, doing very well, progressing very well. And I think if you haven't done some research on these companies, you should. Okay, let's get into it. The first company is Destiny Pharma, of course. And if you've not watched our previous videos on Destiny Pharma, please click the link above there. You can see right at the top there, and it'll go a bit more in depth as to what it's all about. But this week was the first time the new CEO, Chris Tovey, did a presentation on the company and what he's doing, what he expects, where he's going, and his thoughts. And it's very interesting, I thought. But Chris's background, I did a video previously on Chris's background, very experienced in pharmaceutical, as works for big companies, GSK, UCB, GW Pharmaceuticals, Jazz Pharmaceuticals, and 30 years of experience. All right, 10 years as CEO, and there. So he's done a lot, very experienced. Now, three things that stuck out to me during this presentation. Number one is this. Someone asked, why did he choose Destiny Pharma? And I sort of did a video on this previously. Why did he choose Destiny Pharma? Because I say he's used to working in very big, almost multi-billion-pound companies. Destiny Pharma is sub, 50, around 40 million market cap. So why did he choose that? And he said, because of this, the assets. So two late-stage de-risk assets with substantial market opportunity supported by prospective longer-term pipeline. So first of all, the next priority to get a deal on is XF73 nasal. And like I said, it's past phase 2, excellent data, but peak sales here for the US alone, 2 billion. M3 down here, they've already got sort of a partnership deal on this that will fund them through phase 3 trials. Okay, but that's worth about 500 million sales in the US and EU. And they've also got this pipeline on XF73 pipeline here, platform. This is a platform, antimicrobial platform, and they got microbiome and biotherapeutic platform here, which is spore COVID and M3. Okay. Now, this is a sort of a summary of that. Partnering deal with Sabala Pharmaceuticals in North America signed, worth up to 570 million plus royalties. XF73 nasal, new survey of clinicians and payers in the US and the EU supports significant global market opportunity and underscores a $2 billion market potential in the US alone. Okay. And Chris said on this presentation, Destiny Pharma is in a better place than GW Pharma was when I joined. Well, I thought, wow, that's amazing. And he's talking on the assets, by the way, in the company. And just a reminder, GW Pharma, okay? Chris joined here in, October the 1st, and IPO'd in NASDAQ not long after. And it literally did over 1,000% to 2016, okay? And it was bought out for 7.2 billion by Jazz Pharmaceuticals. And he said, because of the assets they have, Destiny Pharma is in a better place than GW Pharma. Okay, and that's why he joined, because of the assets. And he also said it's a strong position to have two phase 3 ready assets that have the studies already approved by the FDA and the EMA. So what does this mean? Of course, going to phase 3 is quite costly, it's time consuming, it's very complex. You need lots of patients you're studying on, but they already have planning approved for how the study will look and what they're hoping to achieve, the endpoints they're hoping to achieve through the FDA and EMA. And he said, this is not usual. It can happen. It does happen, of course, but it's not usual. And having these two studies already agreed with the FDA and EMA is very significant. And someone did say, why have they approved these? And he said, because our medicines is in a huge unmet medical need. There are people suffering, dying, from the diseases that our medicines could prevent. And then secondly to that, of course, there's a huge amount of time, financial burden for the healthcare services and time invested in sort of dealing with these patients. So that's why they're working closely, because it's within the FDA and EMA's interest to get these drugs passed if they pass the phase 3. So they've got a clear design of that phase 3 that they want Destiny Pharma to pass. Also, just to note, there's a new market. This is new. It's the first time they talked about this. And this is XF70 fungal, XF70, global candidiasis therapeutic market valued at $3.1 billion. The large unmet medical need for new topical antifungal agents, particularly those with activity against fungal biofilms. So that's not been mentioned before. So this platform, like I say, it says it supports further development of drugs from the XF platform. That's a platform. Of course, there's XF73 nasal on there. Let me just scroll back, sorry. But there's all these others, treatments now you can use from this platform. This makes it hugely valuable. Okay. And I'm going to point out the broker targets before. I keep covering this, but I don't know of a company with 3 separate broker targets as large as the ones that they have here. And these targets do not include that new market, antifungal XF73 I've talked about, or the full potential of XF73 nasal, because there's no deal done on that yet. But that's the priority. They will be looking to strike a deal. Like I said, they in talks with many companies about this, and one deal, when they find it's a good deal, will get done. I mean, it's just a matter of patience. It will get done, because the market's huge. The potential is huge. It will get done. They just want to get the best deal. And there was talk that would happen within 6 months. Okay. And in fact, before the end of the year, probably. But there you are. That's me just guessing. These are the targets, by the way. Like I said, they don't include the full potential XF73 or the platform. 79 pence from equity development, Cavendish 35 to 90. The average of that is 450% upside from where we are currently. Like I say, it is a bit of risk because, of course, they may not even pass phase 3. There may be some failures there, but it's it's not highly, it's quite unlikely. If you look at the data they have already, on phase 2, they've got a lot of data. They know about the safety and efficacy of the drugs. And so, but nevertheless, because it's pre-revenue, there's still risks involved, even though they said they've got plenty of cash to get, taken through to Q1 2025. So over a year of finance their funding. So it's not particularly, and before that time, a deal should be, way before that time, a deal should be happening on XF73. So that's where the risk lies when you've got a pre-revenue company, okay? But the upside, like I say, is huge, and that could get a lot bigger. As soon as a deal is struck on XF73, that could probably double or more, okay? Next company, Good Energy. Again, very decent upside, but a different risk profile to Destiny Pharma because they are revenue generating, they're making a profit, and they're paying dividends. Okay, so they are a more mature business and not such a high risk business. So they recently changed their strategy, but they were an energy supplier. They owned wind farms and solar farms, which are quite capital intensive, not very good margin. And now they've got a power purchasing agreement from Ørsted. Ørsted, one of the operators, one of those huge wind farms around the country, they're offshore. And also they've got power purchasing agreements with 1,800 independent energy suppliers around the UK, from farms in Wales to hydropower to solar farms. One example on their website is a winery, a local business that creates wine in the south of England. They get solar panels, and any excess energy they create is paid for by Good Energy, and they supply it on. So they are still a supplier of energy, but also transitioning to energy services, and that means solar, heat pumps, EVs, and ZapMap. 49% of ZapMap they own, which is an app that's the most popular in the UK. Tell you exactly where charges are, and you can pay through it as well. There's a lot of data capturing that as well. So, and that's growing very quickly. Anyway, and this is why they've gone more towards energy services. Like I said, the energy supply market, there's very little growth there. And when they sold that, solar farms, wind farms, they obviously reduced their debt massively, and now they've got a lot of cash. But there's no growth in the energy supply. EBITDA margins are very thin, 1 to 3. Working capital intensity very high. Energy services growth market 10-20%. EBITDA margins 10-15, and low working capital energy. So it makes a lot more sense to pivot towards that, because in an area where we are going to a green economy, that is only going to grow. And just a reminder, this is why I think it's quite low risk, because the valuation. is underpinned by more than underpinned by the net asset value. So this is the share price. The market cap is 31 million, pretty much. Enterprise value is 2.2. Why? So cash about 34 million, 34.9 million. They've got a debt of 5 million worth of bonds, which are being paid down. But nevertheless, the net asset value is 50 million. That's £3 a share. So essentially, if you broke this company up and sold all the parts, you still get £3 a share. Okay, so that's why I believe it's low risk. Now, this was the results of this year. 45% growth in top line to 156 million. This is the first half of the year. 32 million, go back to that, 32 million market cap, okay? Net asset value of 50 million, 34 million in cash, okay? Operating profit is 14%, up 2,919. Profit before tax, 13 million. Profit after tax, 12 million. The H1 was always going to be a very strong performer. H2 is going to be weaker. They'll still be profitable. The reason for this is because of tariffs and the energy costs. Okay, so here the tariffs pretty much on the thing here and quite high, so they're being paid a lot of money. Here's energy dropping, but towards the back end of this year, because they've hedged pretty much. They've hedged the margins become weaker here, H1, and then going beyond that, the margin then start widening again. Okay, but nevertheless, because they've made so much money in the H1, they'll still be profitable. The H2 should make a little bit of a loss, but that will unwind and they'll start becoming more profitable again in 2024. And in fact, here are the figures forecast 2023. This is EBITDA 5 million. It's going to double 2024 and then do 40% growth again. And operating profit 3.3 for this year, up to more than doubling again for next year, and 10 million are pretty much there. So you can see even on a sort of operating profit on a multiple of like 10, and you've got 100 million market cap now, 32 million. So you can see the potential here. The broker says target at 475. This is based on 14 times 23 EBITDA or 7 times 24. So that's not a stretch for next year. 7 times next year's EBITDA. That's 475 target. And that's 150% upside. Of course, not as much as Destiny Pharma, but there's very little risk here, or very low risk, because their net asset values are valued way above where the company is. So 2 companies, big upside. And it's this, by the way, that 150% is only based on 2020 4 figures. That would be a lot higher if we take it further out. Okay, but like I said, 2 companies, both with big rewards, one with a bit more risk. But like I said, 2 very, very interesting companies. Please do your own research.